Hi, and welcome to the second episode of Slot Leader. I'm your host, Umed Saidov, and I would like to take this opportunity to thank everybody who's watched or listened to our first episode with Charles Hoskinson. Your support and the response has been tremendous. We've had over 2.6 thousand views for the video that we posted on YouTube over the course of 3 days, and we have amassed 600 subscribers on YouTube. So if you're not a subscriber, please do subscribe to our channel, as we will have a lot of interesting content coming your way. I would also like to thank everybody who's provided their feedback on our first episode. Your feedback is important to us. This is how we know if we're on the right track. If you have any comments or any suggestions, please reach out to us at cardanoslotleader@gmail.com. It's just one word, cardanoslotleader@gmail.com. We welcome your feedback, and we would like to address the questions or comments that you have for the show and make it better. Before we go on, I would like to make an announcement. As you know, we have the decentralized funding available for projects in Cardano. And to that end, I have put in a request for funding for this very show, the Slot Leader podcast. If you are interested in this podcast, if you like the content that I've been putting together for you guys, please go ahead and show your support at cardano.ideascale.com. I'll put up the link in the comment section to the video on YouTube for you. So thank you for your support, and let's get this show started. I would like to remind our viewers and listeners that this show is for educational purposes. Nothing that we say or do in this show constitutes investment or financial advice. In today's episode, we will be focusing on crypto markets. Our special guest, Colin Edwards, is a quant who works at IOG, and he will be sharing his insights about what he thinks about the crypto markets, how it works, and I hope you find this interview useful. But before we do that, let's take a look at the news and the markets and what's been happening over the past week. This past week has been interesting in terms of developments in the regulatory and legal side of things in the blockchain space. In the US, we saw the introduction of 2 bills that try to provide some clarity on the legal status of digital assets and exchanges. The first bill that was introduced is called the Securities Clarity Act, and it was introduced by the Congressman Tom Emmer from North Carolina. The second bill is the Digital Commodities Exchange Act, introduced by Congressman Mike Conaway from Texas. Now, these 2 bills have different kind of purposes. The first one tries to clarify the status of digital assets when they are part of an investment contract. And the second one deals with the regulatory frameworks that are in place for the exchanges, and tries to simplify that as far as I can see. But the articles that you read about the 2 bills, the second one might be a little bit more controversial, because there are legal jurisdictions right now, like Wyoming, that have been fighting really hard in order to create favorable sort of environments for digital assets that might suffer from the if this bill goes into effect. So we'll see how it all goes. These are, again, just bills, but I thought I'd just introduce these to you and talk about them a little bit so that you know what's happening in the industry. On to the Cardano news. On September 21st, Cardano Foundation announced the appointment of its first CEO. His name is Frederick Grigard, and he comes to the Cardano Foundation from PwC. I think in PwC, he was the head of digital financial services. So it's a good appointment, I think, in that the Cardano Foundation needed somebody to spearhead the execution of strategy. So with the Goguen around the corner, it's very important that we have some traction coming out of Cardano Foundation. And I'm glad that now we have somebody that we could, go and talk to and give feedback to at the Cardano Foundation, and who's responsible for driving things forward. since the last time we covered the market, it has shown some interesting price dynamics. The entire digital asset space went down significantly in price, which affected the ADA's price also. We went all the way from 9.1 cent per ADA to 7.5 cent per ADA. But then something happened and we started a steep recovery. In this chart, you can see that the Bitcoin price is in red, and the candles represent the price of ADA. And you see that the magnitude of correction is much higher on altcoins like Cardano, but also on the upside, you get all the benefits. At this point, we're standing at 9.6 cents per ADA, which is higher than when we started, on the 18th. So this has been an interesting sort of development, because I don't remember seeing anything that would justify these price movements. Maybe there was a hedge fund that just unloaded its position in Bitcoin and the entire market moved. Or maybe there was something that I missed. I would like to get your views on this. On the technical side, though, last week we saw some sell and some buy sort of indicators. This week, though, we are seeing a lot of buy indicators here, especially on the moving averages side. So if you believe in the momentum trading, this might provide you with some insights. And we see that on the 4-hour sort of resolution. And if we zoom out a little bit to the 1 day, we still see a lot of buy indicators here. So like with 8 buy and 4 sell. So there's that. I think we might see a slight correction because the steepness of this recovery is just a little bit unreal. But the long-term sort of price movements or the indicators seem to be positive, especially when you move above the moving averages here. So let's see how it all plays out. We can talk about it next week. If you do know what moved the price this time around, I would like to hear your thoughts in the comments. Let me know. Welcome to our show, and it's great to have you today here.
Thanks. It's a pleasure to be here. Thank you very much.
Colin, why don't we get right into this whole thing? I'm really excited to cover a lot of questions today with you. Why don't you tell us a little bit about your background and what you do at IOG?
My background, I was trained as a chemical engineer, and I joined Goldman Sachs in the mid-90s. Working particularly in the risk management area, focusing on mortgages and mortgage derivatives. Moved from there internally at Goldman Sachs into the asset management business, mostly equity portfolios for clients, and jumped after about 10 years to JP Morgan, where I was joined the proprietary trading desk at JP Morgan, doing credit derivatives, which went on for almost a decade. Towards the end of it, I moved more into the commodities area. And then about 7 years ago, I moved into commodities full-time, working for a smaller hedge fund. As the major banks got out of the commodities businesses, I joined the ex-Deutsche Bank commodities prop trading desk, where I've was part of the trading team there for many years. And so it's now on to IOHK. Cryptos are quite a new asset class to me. This is one that I've only been working in for a couple of years, and quite an exciting one. So it's really a pleasure to be involved.
So Colin, how did you find yourself in the crypto space? What was the inflection point for you?
Well, I think a lot of it was looking at what's happening in commodities, where there's a number of things. I think when you look at the real economy of energy and energy trading, there's a lot of pressure on energy companies right now, particularly as they are, battery power is becoming much more powerful. That's going to shrink a lot of the profits in the business. And so I was looking more widely at other types of activities. A number of my contacts had moved into cryptos. And so just from personal recommendations, I began talking with them and became interested in IOHK and the Cardano platform.
I was going to go and ask you about the markets in cryptosphere and cryptocurrency markets. In your experience so far, how are they different or similar to the traditional markets that we've seen in equities and bonds and commodities? Do you have any observations you could share with us?
Sure. One of the big differences, I think, is it's much less clear even what the crypto market is. So that, people know what equities are, they know what fixed income is, they know what currencies and commodities are. But I think cryptos are still in this weird space where they're a little bit different than things that people have seen. And mini coins are one but not the other. And I think that's something that people are still coming to terms with and still struggling even to talk about. And so I think that there is that view that this is a market that still has not sort of fully matured. It's still finding itself, and there are things that look like value stores. There's things that look like means of exchange, but they're not necessarily the same thing. So a little bit different than traditional instruments. I think when you're looking at platforms like Cardano, it's a little bit different. It's sort of like, what would Facebook be if there was Facebook the platform and Facebook the company, and if they were two different entities. That's kind of the state of crypto, so that it's a very kind of different business model. It's an exciting one because it is something new, but I think it's also one that has a lot of challenges because nobody really knows what to do with it, or what are the risks. And I think that's one where there's a lot of unknowns, and it's exciting. It's a very speculative market. It's a lot like the early days of the internet, where everybody knew it was going to be big, but they didn't really know what the winners were. They didn't know what the killer apps were. And so we're still kind of finding our way through that whole process. And I think that's one where it is something we're still coming to terms with about how are companies going to run long term? What are the big things they're even going to achieve? So it's exciting times, but it's still a very young market, and people are still trading on speculation of what it might be rather than what is there right now.
Yeah, I mean, that's one of the things that I've noticed is that all these coins, they kind of move in unison. When you talk about correlations, there's a lot of correlations with Bitcoin, and from a fundamental guy's perspective, which I am, it just doesn't make sense. I mean, Cardano is a completely different value proposition than Bitcoin. Bitcoin is marketed as a store of value, something that you buy and store your wealth in. And Cardano is just this financial operating system with numerous applications that could solve a myriad of problems, from identity to moving value to tracing goods and services. I mean, some of these things have already happened. We've successfully launched and I think in Cardano they traced the sneakers, for instance, right? That there's authentication sort of kind of mechanism that was successfully deployed. But we're still finding those use cases as we are developing the platform itself. And to me, somebody who's very much looked into deeply into the Cardano, it just doesn't make sense that it moves in tandem with Bitcoin. Do you have any thoughts about that? Why that's happening in the markets?
Well, that's a good question. I think there's a couple things that go into that. And so, I think that as a currency-like asset, as a platform or a medium of exchange, greater economic activity does imply a greater demand for currency just across the board. And, so in that way that there should be some linkage, just on the economic cycle. And beyond that, traditional and crypto markets are also strongly linked by technological innovation. These are things that are changing. They're opening up new sources of value and unlocking that value, and there's a growth proposition. So in some ways that you should expect to see a positive covariance, a very high beta. And and I think there is certainly a relationship to the wider economy. As there's more demand, there will be more demand for cryptos, and the more that cryptos will be used as a medium exchange, the higher price will be. But beyond that, I think people are still also struggling to understand the market. It's really hard for an outsider to differentiate, for example, even between coins and tokens, and there's a lot of jargon used within the industry. There's a very high barrier to entry where to look at a coin, you might even need to download a full node wallet. It might need to synchronize. Buying crypto is not easy for a lot of people, where you might have to use some fiat gateway to get some Bitcoin, transfer it to exchange. You have to manage your own keys. So I think there's a lot of difference, so that a lot of people aren't really looking strongly at individual cryptos to an extent. So I think that's one thing is people fail to differentiate between different tokens, and part of that is just due to the nature of the kind of high barrier to entry into the network. And I think it's also a marketing opportunity, that this is something that we need to do better to communicate how we're different as a product, and kind of what our own vision is, and the strengths of the platform. So that's something that we're looking at internally. I'm working quite closely with our media team to kind of understand and how to get that message out. So it's something, but also to kind of jump on that, I think there's something algorithmic in nature about this as well. When any coin moves, there are enough players that just adjust everything in line so that markets stay correlated. And we see that across markets and also across coins, is that things very much stay in line. So there are algorithmic trading that is making that happen. It's happening at too quick a scale to just be individuals doing it. So there are clearly large algorithmic traders that are kind of keeping these things in line. And the way I would explain it is there's more of a view of cryptos as an asset class. Are you bullish about the asset class? And then it just kind of, you're just long all the coins, or at least a subset of coins. You might see altcoins versus stable coins, maybe versus some of the newer DeFi or yield farming. But the correlation, it is very, very strong.
One of the things that I've been kind of toying with in my mind is a framework to evaluate these movements. I was kind of thinking maybe the reason why there's such a strong correlation, and I see that when Bitcoin all of a sudden jumps or drops, those are the ones where the whole market bleeds, and the beta is higher on the altcoins. For those viewers who do not know what the beta is, it's just basically a correlation of an altcoin, let's say, to the total market, and I see this as a sign that if a large player is coming into the market, right, the crypto market, do you think that the fact that there is strong correlation has to do something with liquidity of Bitcoin? It would be a kind of a gateway crypto for everybody to come in and buy large quantities of this asset without moving the price or losing in spreads there, and then from there moving into whatever they want to buy. Let's say that I'm bank or hedge fund X and I really like Cardano, but if I dump all my money in Cardano, the markets may not be able to sustain that level of purchasing, and will move the price significantly, so that I will lose on the on the bid ask spreads there. Do you think that has to do something with those kind of purchasers and institutional investors?
Well, that's a good question. Generally, I haven't seen any evidence of it. It might be happening, but I actually think that it tends to be more people just being generally long or short the market, rather than having a view on individual companies. Now, there are certainly cases where coins will break away, and go to a new level to each other. So the percentage moves seem to be very stable over time, so that you look at, all the coins might be up or down 2 or 3%, so that the changes tend to be more correlated than the actual levels, so that there can be a jump to a new relationship. So a coin can enter a new relationship and stay there relative to it. I don't think it's necessarily driven by just liquidity, because if it was just liquidity driven, there would be it would be a little bit more random, to say that all these coins are moving in a way that is highly related. They're each going to have their own liquidity characteristics. That trading across and around time zones would be quite different. So I think that it is actually kind of algorithmic, almost follow the leader type moves, so that the leaders may change day to day. Like in the last week, we might have been seeing things like Uniswap or Yearn moving the markets and tending to lead things by maybe a couple minutes. And over time, that I'd say that at the start of the week, you might have seen Uniswap leading by almost an hour. And now, as more and more people are identifying that and picking it off, that to me feels like professional traders are kind of pricing that in as a leading indicator, taking some profit from it. And in a week or two, it'll have to be somebody else. Those kind of relationships don't stay, or people start trading on them quite aggressively.
Interesting, Colin. Now you mentioned that you are building models for IOG. Do you have any insights for us to share at this point in time in terms of the price of ADA and correlations and things that are important to watch out for? And we don't have to go deep inside them, do the in-depth analysis, because the listeners would not be able to see what we're showing. But in general terms, can you tell us what's important and what's not?
So I think we've identified a couple things. One is we want to keep a really high level of quality and trust about the technology, and we also want to start building up, kind of a set of long-term direction about, kind of what the mission of the platform is and where we want to go. And those are things that I hope we're going to be coming out with much more widely. Some of them, I think Charles has already talked some about where internally we're going to be taking the mission of the company and picking projects that are aligned with that. So, I think the things that we focus on are real delivery, not just pushing out a half-finished project to meet sort of an almost arbitrary deadline in some cases, claiming success. We're trying to avoid partnership announcements that are just noise. We want to talk about things that are really critical and driving, that we feel are strategic in strategic partnerships and long-term value. So I know that was a total digression about the short-term prices of what is driving short-term prices. So there's a lot of things, to come back to the original question after my long disclaimer. News announcements, a lot of cryptos are still very speculative projects. So things that confirm real application or real utility or real value tend to move the price up. And those are things that we want to capitalize on, of, talking about what's the real use case for this, this fancy technology, what can you do with it? So that's one that we really want to communicate and get out. I think we need to be much more open about deadlines and project schedules and timelines. And so that's one, I think, that getting better communication out, explaining why certain things need to be done in certain orders and what our own internal timelines are, is going to be one. And I think so that there are no surprises in the market would certainly be where we want to go. I think when people say, is this coin real or is this a scam? I hate to say it, but in the crypto world, you always have to be worried about that. And, that's one where we want to make sure that we do not ever lose that level of trust, either in our technical ability of delivering really solid code, our kind of theoretical research, or, by pushing out something early or doing something half finished. So there is kind of risks on both sides of that, and some of them are what's happening to the coin. So things that drive the coin: real utility, real value. There's kind of macro trends that are driving things. So it's sort of like the tide, and you've got waves. The public will be interested in coins. Things will make the headlines, and sometimes it's something like, if any coin ends up on Forbes or the Wall Street Journal or The Economist, that tends to spark interest in the whole ecosystem. And
I see.
I think we also need to be looking not just at ADA in isolation, but really thinking about how crypto coins can clean up their act and start really communicating their value proposition and things like that as well. So those are the
Yeah,
kind of things that I tend to be more focused at, and keeping people away from just price bumps. Sometimes it was just somebody selling in a hurry and sloppily. Sometimes it is the whole market reacting to Uniswap
yeah.
and just moving. And so it's not always strictly rational. So even in trading strategy, I tend to heavily favor relative value trading over just directional kind of calling the market type trading.
Do you think crypto markets are efficient? I mean, I see a lot of decoupling between the prices and fundamental value, but I am one guy who has done his work. And I think that the fundamental value is there for certain projects. And markets tend not to agree with me sometimes. And I kind of find myself in this position. I think Newton said that, markets can be irrational more than you could be liquid. So you don't want to find yourself in that position, which means that you need probably products to hedge your bets if you are in this space, because the whole price movement could be very volatile. So yeah, so I mean, do you have any thoughts about, if supply, a capped supply, is at play here in terms of affecting the market prices?
Yeah, I think there's a lot of things that people are working with on that, and I think, just to echo your point, there are some really good fundamentals in crypto, and there's a really good story there, because I think there's so many really dodgy coins that the whole market is kind of tarred with the same brush of, is this real or not? And people can't distinguish in that. And so to some extent, it's something of a lemons market, where, much like used cars, everybody kind of pays the price on the value of the coin, because nobody can tell what is a good coin. And beyond just having a good technology, I think you also need to have the right applications. And this is something that, as a company, say IOG well, I don't know if we've changed the logo on the towels yet, but it's coming. We're still, coming with is there's two parts of, there's a technology that you can trust. There is a kind of a leadership team that you can trust. And then there's also getting the right applications and use cases on there, so that even if you've got an amazing technology, you still need to get people using it, and the right people using it. And that's something I think as a company we're struggling with, well, or at least historically, and it has changed dramatically this year in terms of kind of setting out where we want to go in terms of a long-term vision and working towards it. And I think that's a very healthy thing about thinking about, where do you want this platform to go? What do you want it to achieve? And I think that, I'll just put it bluntly, I think that we've got a really good story with kind of economic identity and inclusion. And this is going to factor into a lot of areas. I think that the low interest rate environments really make this a very attractive value proposition. But I'm struggling to remember what your original question was. If you want to repeat that, I think I might have gotten myself off.
No, we were talking about efficiency of markets, probably. Efficient. I know that I probably veered off that question myself, but I see the disconnect. I see the decoupling. But my main point was that no matter how solid the fundamentals are, the market could be very irrational, in my view, which could negatively affect your positions in your livelihood if you are putting a lot of money into this space, more than you could afford to lose or whatnot. Which also brings me to another topic, derivatives.
Well, let me answer your question on are they efficient, just really quickly. Not at all. The information is very scattered and not well distributed. Cryptocurrencies do not have the same kinds of disclosures that you do with public companies. And in many ways, the regulatory situation is unclear. As a company, IOG has taken a very much of a policy to not trade on non-public information and to not profit on it. And we've drawn a very strong line as if we are, or it sometimes could be, a regulated company. I hope not, kind of knock on wood. I don't, that's something that you always have to think about is how would the public perceive this? And, but there's quite a lot of information that is still very private. Major players have a lot of information that other people don't. And I'm going to say people like staking pools are in a position to see large numbers of flows that other people can't. Exchanges are in a position to see a lot more information than private individuals have. And even though the blockchains themselves are public, identifying and working through those chains is very challenging and takes a lot of technology and insight. And the companies that do that are still very early on in their life cycle. And news outlets and information aggregators, I think, are still pretty dodgy in the market. Even good ones, you'll see largely are funded by advertising revenue from coins or maybe exchanges that they're not doing any kind of vetting on.
But in case of anomalies, I wanted to just basically get into these. I don't know how closely you're watching the markets at this point, but have you seen any anomalies? I know that in early days, if I remember correctly, I wrote a Python script that would take a look at two exchanges and would do a three-way arbitrage, right? So you just look at two exchanges, and then if there's a price difference, you buy in one exchange and then sell in another exchange, and you might add another coin in between to juice up the rewards, the returns. Those kind of trades do not exist anymore, and I think that's because the market has become more efficient. But do you see any anomalies that could be useful for somebody out there who's engaged in this kind of activities?
Absolutely. And I think when you're looking at trading, you should kind of mentally break it into the three different parts. And one of them is long-term investing and a value proposition and looking at the things that have a value. The second thing I think you can look at is where you're actually providing a value or a service. And this is going to be a long-term revenue generating. And those are going to be things like providing liquidity into the market. So a large miner might come in and want to just get rid of his coins. You could take the other side of that. And one of the things I think is really exciting about crypto exchanges is you can be a market maker. You can sit out there and you can buy that up and just turn around and resell it yourself for money. And I think you have to be a little bit, you can't be too invested in the assets when you're market making. You're just trading as a business to buy low and sell high, but you're providing a real value of, making a market for people. And so you're making the other side of the bid-ask spread. And that's, I think a very consistent and a great money maker for people. These are 24-hour markets, and in some periods there's low volumes, and so that if you are available to put your own capital at risk and take some of the liquidity there and then just resell it to higher volume periods. For example, it's often the case that in the European morning, the volumes are thinner than in the US, so that you can literally just sit there and buy all morning and turn around and sell in the afternoon and just take up any liquidity. And so there's opportunities like that are long-term value. And sometimes you see what I would think of as anomalous sales. Somebody comes in and moves a large amount of coin that they shouldn't move in that period, where you see the volumes at 3 or 4 times normal volumes. And those are opportunities you can jump at to jump in. And, I think at that point, it's also worth having a program that's also scanning news. So when we're looking internally at our own analytics, we tend to have 3 different things we look at, which are kind of pricing. Some of them are things like on-chain metrics and other fundamentals, and then there's kind of a news scanning. So if you are looking and picking up chatter about a coin, maybe you're going to say the Telegram group or the Twitter chatter has a lot higher volume. Maybe you don't want to step in. Maybe there's some news coming out that you don't, you're willing to make a market for liquidity, but you wouldn't do news. So you might have a filter on that. So you could easily do something like that where you're taking long-term anomalous. And then you have straight up arbitrage, where you see market inefficiencies, where one market is, let's say like the 3-way coin trade that you saw. If you can see opportunities like that, or if you have a situation where you can borrow money, and the DeFi loans are, I think, a case where you definitely see this kind of crazy arbitrage where you can borrow money at one rate, make a loan, use the loan as collateral for the next loan, borrow again at a lower rate, lend it at a higher rate. You can very quickly bootstrap yourself up to very good yields. And is that sustainable, or is this kind of the same thing that we saw with say structured credit and calling, maybe, I think, it's funny to see the crypto market, which in some ways was a reaction to what happened in 2008, about how to build a better bank, create, kind of running into the same banking problems. And those are things we pay a lot of attention to because it is a big risk for a company like IOG in that situation, both reputationally, where, people think of cryptos largely as an asset class, and we kind of fall in that asset class. So any credibility loss is bad for us. And in the same way, I think that there's often this chatter about one coin versus another. Each coin has some partisans, but I think internally we tend to take a very positive view on other crypto coins. And I'm going to take Ethereum. Ethereum's not our enemy. We want to talk up Ethereum as much because we're both kind of riding the same wave. If they're successful, we're going to be successful. If we're successful, they're going to be successful. And we kind of view that as we're together and we need to sell this whole asset in a way of doing business. And we're looking to grow the business not by cannibalizing another coin, but by actually reaching out and engaging new people and bringing them into the coin. I think that cryptos as an asset class have kind of tapped out sort of the natural partisans of the people that, would naturally download a full node and try to do a little bit of mining from home. And that group of people is now kind of hit maximum saturation. We now need to be reaching out to new audiences and people that maybe you're finding the current crypto market a little bit inaccessible.
What do you think is the main barriers in the minds of, let's say, professional finance people to come into this space and start building on platforms like Cardano?
I think from a financial services point of view, if you're in let's say a Western economy, for example, that has a good regulatory environment, that is well banked, where you can go to your bank and save money, where you can transfer money easily and frictionlessly, where you can manage your investments, and you have a faith in the companies, maybe some of the selling points of blockchain are less so than in third world countries or other countries where the regulatory regimes might be as clean or where you're trading across borders. So I think there's a lot of companies that are in certain markets. And for example, Western Europe, North America, in some areas, Japan, the regulatory environment is pretty well understood. The regulators work together, and companies have a lot of limitations, but they kind of understand those and they understand the markets. And getting into another country, let's say running a stock exchange, maybe in Africa, maybe not be, maybe a very new and challenging business for them. And if they were going to do that, blockchain looks like a great technology, but is there a huge push to say overturn how traditional exchanges work in a Western area? And the answer is there might not be, that people can rely on them, they have access to them. So I think we're really looking at people that do not have access to those kind of tools. And the reason that companies don't want to get in there is they don't necessarily trust the governments. If you're operating in a country that doesn't have a stable currency, that you don't trust the regulatory environment, if it's war torn, or potential for violence, those are all cases where companies might stay away. And I think that in well-regulated companies, there's a lot of countries where business is done more on who you know, and there's a concept of say facilitation payments that Western firms just can't touch. That it's just a no-go area. And so if you were going to do business there, having a neutral technology is a great enabler. But in let's say within the UK or in the US, the regulatory environment, there's no huge advantage to blockchain in that case of providing that. So I think when you see the innovation, you probably are looking either cross jurisdiction or you're looking at areas, so I think we're probably going to see a lot of innovation coming out of newer areas, not necessarily, let's say, changing the way, let's say my parents or your parents might bank, because they're probably pretty happy with their bank at that point. It's stable. It's gone through a couple of crises. There was no meltdown. There was no run on banks in 2008. I think that people have kind of gotten to the point where they feel they're pretty comfortable in that. Will there be a run on Tether in the next 10 years? There might be. I mean, and if it did, what would happen? Would exchanges step in and bail Tether out, or would there be some sort of tailspin, a situation? And until those things happen, I think that some of the questions, and I'm using Tether as an example because, conceivably a lot of people could just ask for that money back if there was a lack of confidence in it. Those are assets that are supposedly somewhere. But, I think there's a lot of open questions like that. Whereas I think that if you're in the US or the UK, you don't really worry too much about, your checking account.
Yeah. Look, Colin, to that, I would like to sort of explore this angle a little bit further, because I think it's important to understand that technology like blockchain, even though its maximum value is in emerging markets where there's nothing, this type of structures do not exist. I think there's still case to be made. There's a case to be made for developed countries to adopt it in a way that it, let me give you an example, right? When cell phones came, even though the first cell phones were expensive, I remember I used to work for a US embassy, and our ambassador basically got the first phone. It was $10,000 in 90s, right? And then the cost came down. So that's how the new technology usually works. It comes with prototypes, and then the prototype gets into a first wave of products, which is very expensive. And then slowly it just starts going down the price, and then it becomes very competitive with incumbents. And what it does in that span of time, it gives the incumbents enough time to reorganize themselves. So you see AT&Ts of the world, which operated the payphones, become cell phone companies and internet providers, right? So with blockchain, right off the bat, right off the gate, it just completely disrupts the banking system in the sense that it's cheaper to send your US dollars from one place to another. It's instantaneous, right? That no bank with its current structure can compete with. They have to go bankrupt because they have such a big cost structure baked into their product offering that they will never be able to match those products. And what we've seen in the US at least is that now banks can custody US dollars that back digital currencies. It's a fact. We are moving in that direction, and in Wyoming especially, you open up a company, a type of a bank that has 100% reserves, and you can just hold your coins there, and if you need the coins back, if it's a US dollar digital coin, they're there. There's no fractional banking in there in that regard to have any risks. So we are seeing some movement in that direction, a slow movement, albeit, but I think the technology itself will reorganize the way that banks work. Because let's fast forward 2 years. The way I see it is that in 2 years, instead of sending wires, right, between my bank and your bank, which takes 24 hours and $15, I could see myself sending digital dollars. And since digital dollars are in my bank, and having those connections between the digital assets and traditional assets, so to say, I will be able to spend them even. So that's the way I think it's going to sort of come into the traditional financial systems and start reorganizing them from inside. Like it or not, if I'm a bank, right, And if I have a, uh, a technology that decimates the cost structure of my business, and I can pass on those costs to my shareholders, I kind of have a fiduciary duty to exploit that. Not to exploit that, but to use that technology in order to do that. I can do analysis of NPV of a project like that and make a case to the board of directors, especially if the regulatory side of things have become more clear, which is the case in the last 2 months. That I would jump on that situation, on that opportunity. And given the fact that we have a higher demand for digital assets like U.S., digital U.S. dollars and whatnot, I would be probably able to charge higher interest and offer higher interest on those deposits to encourage liquidity growth. So what do you think about that?
I think banks and in let's say the UK or in the US, I think banks have responded in the last 10 years strongly to this. That when I send money now to anyone in the UK banking system, it's usually crossed in a couple seconds, and it is essentially free. There is no charge that goes through. And so even transferring large amounts of money, I think that kind of international remittances, when you cross jurisdictional boundaries, that if I was going to send, let's say if I went on holiday with my brother and we were going to settle up, kind of the meal differences, we kind of added up and said, you bought 2 more meals than me, I'll send you the difference. I was going to send him a little bit of money to cover that. That might be a more challenging thing internationally. But I think that's still a very limited use case of international remittances. And I think Bitcoin's actually done a pretty good job at that, in terms of international payments. And so when I see the growth, I think it's going to come into a couple different ways, not just international remittances. I think it's more driven, or at least some of the challenge I see is economic growth is not just about scarcity. It's not just about transferring value, but it's actually about productivity and driving the production of value. And I think the Bitcoin niche of transferring money is well it's filled. that coins need to be thinking, what else are we going to do with that kind of market? And right now there's a lot of money floating around looking to generate a return by solving problems. And this is a problem that everybody has, is where governments are locked into a very low rate environment, and it's going to be very hard to get out of that cycle that they're in. Just raising rates may not work, and if it did, it might be very difficult for people, let's say with floating rate mortgages. That would be very unpopular. So I see a lot of drivers being external. I think blockchain opens up a lot of opportunities for investors to invest outside of traditional markets and in companies. And that will be one way to kind of, the competition for those funds will be one way to raise interest rates generally. And I think cryptos are a huge enabler of opening up new markets. And, the challenge is how do you connect those funds with people who have problems to solve and know how to solve them? So, I think when you're looking in, let's say you're a farmer in Africa and you need to take a loan, there may be a lot of issues with that. There may be kind of supply side issues of maybe these cryptos are so hard to use, you don't know how to do it. Maybe there are kind of demand side of you're not even kind of digitally very aware. Maybe you're a woman, maybe that it's not traditional in your country to even think about economics. So there is kind of a lot of external frictions about how would you borrow funds and make things work. And I think this is something that in classical economics, they tend to skip over these frictions. It's sort of, classical capitalism of how do you get money to the people who need it, the transition issue of, how do you take people that have money to invest and get it to people who have problems to solve. It's valuable for both people, but there's often a lot of friction. And I see blockchain as a technology to kind of reduce some of those frictions. And that's, can you span jurisdictional boundaries? Can you depend on trust it's not centralized? And that would allow trade in waves that it's previously, or up to now has been very, very difficult. And so those are things I think that blockchains should be looking at. I think that Cardano's got some great answers on that, because, you know, when you're thinking about a platform of economic identity and financial inclusion, you know, that's how do you open up those opportunities? And one of those is trust. You know, how do you, and that's very linked to the identity problem, you know, how to build a platform that lets people connect as people to others that they know and personally interact with in a way that preserves your privacy and allows you to get that trust. And I think there's a really, you know, and that opens up loans to people that, you know, maybe can't get loans. Maybe they think, if I only had more money, I could plant a lot more acreage. You know, I could invest in things like irrigation that would give me much greater returns. And so when I look at the opportunities, I think about how to invest in areas that are in some ways uninvestable right now. And that's going to be a huge driver of value, both for Western economics, you know, where you're thinking, how do you get yield? You know, you've got some money that you want to pay for your retirement if you want to cover costs. What do you do with it? And so there's huge advantages out there. I think that'll be probably more of the driver for cryptos.
My interview with Colin was so extensive that we had to break it down into two different segments. So this is the end of the segment 1 of this interview, and the second part of the interview is also available as part 2 of the same episode.